Imagine this. Your alarm goes off at 6 a.m. You drag yourself out of bed, get ready, and head to work. Maybe you're sitting in traffic every morning. Maybe you're commuting on a crowded train. Or maybe you're working from home, staring at the same screen for hours every day. You work hard. You show up on time. You do what you're supposed to do. Every 2 weeks, your paycheck arrives. You pay your rent or mortgage. You cover your bills. You buy groceries. Maybe you put a little money into savings. Maybe you even invest a small amount whenever you can. Then you do it all over again. Week after week, month after month, year after year. And yet somehow, your financial situation doesn't seem to change very much. Sure, you're making more money than you did a few years ago. Maybe you've even received promotions or raises. But despite all that effort, it still feels like you're running in place. You look around and wonder if you're missing something. Because according to everything you've been told, you should be getting ahead by now. Here's the thing. The problem isn't necessarily that you're lazy. It's not that you're irresponsible, and it might not even be that you're not earning enough. The real problem is that most people spend decades working for money without ever learning how money actually works. And that single misunderstanding can keep someone financially stuck for their entire life. Today, we're going to change that. My name is Demas, and I spend way too much time thinking about money. If you're someone who feels stuck financially, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Now, let's talk about one of the biggest financial beliefs most of us were taught growing up. From the time we're children, we're given a very specific roadmap for success. Study hard. Get good grades. Go to college if possible. Find a stable job. Work hard. Save money. Retire someday. And to be fair, none of that advice is bad. In fact, those things can absolutely help improve your life. But here's what most people don't realize. That advice was never designed to make you wealthy. It was designed to make you employable. There's a huge difference. Look, school teaches us how to solve equations, memorize facts, and follow instructions. But very few people ever receive a real education about money. Nobody explains how debt works. Nobody explains how investing works. Nobody explains why some people become wealthy while others spend their entire lives working. Instead, we're taught to focus almost entirely on earning income. And that's where the problem begins. Because income and wealth are not the same thing. A person can earn a six-figure salary and still be financially stressed. Another person can earn far less and quietly build substantial wealth over time. This is where it gets really interesting. Most people spend their lives trying to earn more money. Wealthy people spend their lives learning how to keep more of the money they earn. And that single shift in thinking changes everything. Now, before anyone misunderstands this point, hard work absolutely matters. Working hard can help you earn more money, develop valuable skills, and create opportunities that wouldn't exist otherwise. But here's the uncomfortable truth most people never hear. Hard work alone does not guarantee wealth. If it did, millions of hardworking people would already be financially free. Think about the people you know. Maybe it's a construction worker putting in long hours under the hot sun. Maybe it's a nurse working overnight shifts. Maybe it's a delivery driver, a factory worker, or a small business employee. Many of these people work incredibly hard every single day. Yet a lot of them still struggle financially. Why? Because wealth is not created by effort alone. It's created by what happens after the paycheck arrives. Look, imagine two people. The first person earns $50,000 per year and manages to save and invest $15,000 annually. The second person earns $120,000 per year, but spends almost everything they make, saving only $2,000 per year. At first glance, most people assume the second person is wealthier. After all, they're earning more than twice as much money. But over time, the opposite can happen. The first person is building assets. The second person is building expenses. And assets grow. Expenses don't. Here's what most people don't realize. Your income determines your lifestyle, but your savings and investments determine your future. A higher income can certainly help. But if spending rises every time income rises, financial progress often stays exactly the same. This is called lifestyle inflation. You get a raise. You upgrade your car. You move into a more expensive apartment. You spend a little more on vacations, a little more on subscriptions, a little more on eating out. And before you know it, the raise is gone. The extra income disappeared. Not because you made a mistake, but because your lifestyle expanded to consume it. This is where it gets really interesting. The people who build wealth aren't always the people with the highest incomes. They're often the people who create the largest gap between what they earn and what they spend. That gap becomes savings. Those savings become investments. Those investments become assets. And eventually, those assets begin generating income on their own. That's when the game starts to change. This is where money starts to feel almost magical. Not because there's some secret trick. Not because wealthy people know something completely different. But because most people underestimate the power of time. Let's look at a simple example. Imagine two friends. Both want to build wealth. The first friend starts investing at age 25. The second friend waits until age 35. The first friend invests just $500 every month for 10 years and then stops completely. The second friend invests the same $500 every month but continues all the way until retirement. Most people assume the second friend will end up with more money because they invested for longer. But surprisingly, that's not always true. Why? Because the first investor gave their money something incredibly valuable, time. Here's what most people don't realize. Compounding doesn't grow in a straight line. It grows like a snowball rolling downhill. At first, the snowball looks tiny. Progress feels slow. You invest for months and barely notice a difference. You invest for years and still wonder if it's working. Then something changes. Your money begins earning returns. Those returns begin earning their own returns. And suddenly growth starts accelerating. Let's use real numbers. If you invest $500 every month into a broad market index fund earning an average of 8% annually, after 10 years you could have around $90,000. After 20 years, nearly $300,000. After 30 years, more than $700,000. Think about that. You contributed roughly $180,000, yet your account grew to over $700,000. Where did the rest come from? Time, compounding, patience. This is where it gets really interesting. Most people focus on finding the perfect investment, the perfect stock, the perfect strategy. But the biggest factor in wealth building is often not what you invest in. It's how long you stay invested. The earlier you start, the harder your money works. And eventually, there comes a point where your investments earn more in a year than you personally contribute. That's the moment many people finally understand what wealth really is. It's not about working harder forever. It's about giving your money enough time to start working for you. Now you might be thinking, if building wealth is really this simple, why doesn't everyone do it? It's a fair question. After all, the math isn't that complicated. Spend less than you earn. Invest consistently. Give it time. So why do so many people struggle? Because personal finance is far less about mathematics than it is about human behavior. Look, your biggest financial enemy usually isn't the stock market. It isn't inflation. And it isn't even a lack of knowledge. Most of the time, it's your own brain. Human beings evolved to survive immediate threats, not to plan for retirement 30 years in the future. Our ancestors were rewarded for focusing on what was right in front of them. Food today mattered more than food next month. Safety today mattered more than safety next year. And even though the world has changed dramatically, our brains haven't changed nearly as much. Here's what most people don't realize. We're naturally wired to prioritize immediate rewards over future rewards. Psychologists call this instant gratification. Imagine someone offers you two choices. You can receive $100 right now, or you can receive $150 1 month from now. Logically, waiting 1 month for an extra $50 seems like an easy decision. Yet many people still choose the immediate $100. Not because it's the smarter option, but because the reward is available today. Now apply that same thinking to everyday life. A new phone today feels exciting. A luxury vacation feels exciting. A brand new car feels exciting. Investing that same money for a future that feels distant and abstract? Not nearly as exciting. And that's exactly why so many people remain stuck financially. The challenge isn't knowing what to do. The challenge is doing something that feels uncomfortable today for a benefit you'll experience years from now. This is where it gets really interesting. The people who build wealth aren't necessarily more intelligent. They simply become better at delaying gratification. They learn to sacrifice a little comfort today in exchange for significantly more freedom tomorrow. And over time, those small decisions create dramatically different outcomes. Because wealth isn't built in a single moment. It's built through thousands of choices that nobody else notices. One of the most common financial questions people ask is surprisingly simple. Should I invest my money or should I focus on paying off debt first? At first glance, it sounds like a difficult decision, but the answer becomes much clearer once you understand the numbers behind it. Let's imagine you have $10,000 in credit card debt. That debt is charging 24% interest every year. At the same time, you're investing money in the stock market, hoping to earn an average return of around 8% annually. Now think about what's happening. You're trying to make 8% on one side while losing 24% on the other. Mathematically, you're moving forward and backward at the same time. Here's the thing. Paying off that debt is essentially giving yourself a guaranteed 24% return. And opportunities like that are extremely rare. This is why high-interest debt is often one of the biggest obstacles to building wealth. It quietly works against you every single day. But now let's change the situation. Imagine your debt is a mortgage with a 3% interest rate. Suddenly, the calculation becomes very different. If your investments can reasonably earn 8% over the long term, keeping that low-interest debt while investing may actually make more financial sense. This is where it gets really interesting. Most people want a universal rule. They want someone to tell them exactly what to do in every situation. But personal finance doesn't work that way. Good financial decisions depend on context. They depend on interest rates. They depend on risk. And they depend on your personal goals. Here's what most people don't realize. Every dollar you earn has a job. You can spend it, save it, invest it, or use it to reduce debt. But once you choose one option, you automatically give up the others. Economists call this opportunity cost. And wealthy people think about opportunity cost constantly. They understand that every financial decision involves a trade-off. The goal isn't to make perfect decisions. The goal is to consistently make decisions where the long-term benefit outweighs the short-term cost. And that's often what separates people who stay financially stuck from people who steadily build wealth over time. There's another financial trap that quietly destroys wealth, and most people don't even realize it's happening. It's called loss aversion. And it affects almost everyone. Here's what most people don't realize. Psychologists have found that people feel the pain of losing money much more intensely than the pleasure of gaining the same amount. In simple terms, losing $1,000 hurts far more than gaining $1,000 feels good. Now, that might not sound like a big deal, but when it comes to investing, it changes everything. Imagine you've spent years saving and investing. Your portfolio finally reaches $20,000. You feel proud. You feel confident. Then suddenly the market drops. A recession hits. Bad news fills the headlines. And your portfolio falls to $16,000. Overnight, you've lost $4,000 on paper. Even though nothing about your long-term plan has changed, panic starts to creep in. You begin questioning everything. Maybe investing was a mistake. Maybe the market is too risky. Maybe you should sell before things get worse. And that's exactly what many people do. They sell. They move their money to cash. They stop investing altogether. The problem? Markets eventually recover. Historically, every major downturn has been followed by recovery and growth over the long run. But the people who panic often miss that recovery. Look, the biggest losses investors experience are not always caused by the market itself. They're often caused by emotional decisions. This is where it gets really interesting. Successful investors aren't people who never feel fear. They absolutely do. The difference is that they understand fear is part of the process. They know that temporary declines are normal. They know volatility is the price investors pay for long-term growth. And most importantly, they understand that patience often beats prediction. Because nobody can consistently predict what markets will do next. But disciplined investors don't need to. They simply stay focused on the bigger picture. And over time, that ability to remain calm when everyone else is panicking becomes one of the most valuable financial skills a person can develop. At some point, every wealthy person discovers a lesson that completely changes the way they think about money. And once they understand it, they can never look at money the same way again. The lesson is simple. Wealth is not built by working for money forever. Wealth is built by owning things that generate money. Look, most people spend their lives focused on income. They ask questions like, how can I get a raise? How can I earn more per hour? How can I work more? And while those questions are important, they're only part of the equation. Wealthy people ask a different question. They ask, how can my money work for me? That single shift in thinking changes everything. Here's what most people don't realize. There are only so many hours you can work. Your time is limited. No matter how hardworking you are, there will always be a ceiling on how much labor you can personally provide. But assets don't have that limitation. Assets can generate value 24 hours a day, 7 days a week. Whether you're working, sleeping, traveling, or spending time with your family. Think about a business owner. The business continues operating even when they're not actively working every minute. Think about a rental property. Rent can still arrive while the owner is asleep. Think about stocks. The companies behind those shares continue producing products, serving customers, and generating profits regardless of what you're doing. This is where it gets really interesting. The wealthy don't just accumulate money. They use money to acquire assets. And then those assets generate more money, which allows them to buy more assets. Over time, this creates a cycle that becomes increasingly powerful. Money creates assets. Assets create income. Income buys more assets. And the cycle repeats. That's why many wealthy people appear to get richer faster over time. It's not necessarily because they're working harder. It's because they've built systems that continue producing value even when they're not directly trading their time for money. And that's one of the most important financial lessons school never taught us. At this point, you might be thinking, okay, I understand the concepts, but what should I actually do next? And that's the right question to ask. Because financial knowledge only becomes valuable when it's followed by action. The first step is simple. Know where your money is going. For the next 30 days, track every dollar you spend. Not because budgeting is exciting, but because you can't improve what you don't measure. The second step is building an emergency fund. Life is unpredictable. Cars break down. People lose jobs. Unexpected expenses happen. An emergency fund creates financial stability and prevents small problems from becoming financial disasters. Third, eliminate high-interest debt as quickly as possible. Every dollar of expensive debt is working against your future goals. Fourth, start investing consistently. Not when the market feels safe. Not when you think you've found the perfect opportunity. Start with consistency. Because consistency usually beats perfect timing. Fifth, continue increasing your earning potential. Learn new skills. Improve your expertise. Seek opportunities that increase your value in the marketplace. The more value you create, the greater your income potential becomes. But here's the most important lesson of all. Financial success rarely comes from one life-changing decision. It comes from hundreds of small decisions repeated over many years. Look, school taught most of us how to pass exams, how to memorize information, how to follow instructions, but very few people were taught how money truly works. The good news is that it's never too late to learn. You don't need to be a financial genius. You don't need a massive income, and you don't need to get everything right. You simply need to understand the principles, stay patient, and remain consistent. Because once you understand the rules of the financial game, you stop feeling stuck. You stop guessing. You stop hoping. And you start making deliberate decisions that move you closer to financial freedom. And that's when money stops being a source of stress and starts becoming a tool for creating the life you truly want.